in 1972.
Warren Buffett paid $25 million for a small California candy company. 54 years later, that one business has generated over $2 billion in pre-tax profits. And the reason comes down to something most investors never even look for. Buffett calls it an economic moat. And finding one is the difference between a business that compounds your wealth for decades, and one that looks brilliant this year, then gets crushed the next. Today I'm walking you through the exact checklist I've used for 50 years to spot a real moat. The 5 types that actually last. And the third signal is the one most investors completely miss. Picture a castle. Around it, a wide, deep moat. Inside the castle, there's a business generating cash. The moat is what keeps competitors from swimming across and stealing that cash. That's the whole concept. A moat isn't this company is popular right now. It isn't this stock is going up. A moat is a structural, durable reason why competitors can't just copy what this business does. It's the reason Coca-Cola can charge more for sugar water than a generic brand can. It's the reason you can't just start a credit card network in your garage. And here's the thing most people miss. A moat isn't about what the business does today, it's about what protects the business 10, 20, even 30 years from now. So how do you actually spot one? There are exactly 5 types that have stood the test of time. Type 1, brand power. Not every well-known brand has a moat. But a true brand moat means customers will pay more, walk past cheaper alternatives, and choose this product almost without thinking. Coca-Cola is the textbook example. Buffett invested $1.02 billion in Coke back in 1988. Today, that position is worth more than $25 billion. The moat? The brand. People don't drink Coke because it's objectively the best soda, they drink it because it's Coke. Type 2, network effects. This is when a product gets more valuable as more people use it. Visa and MasterCard are the classic examples. More cardholders means more merchants want to accept them. More merchants means more cardholders want the card. It's a flywheel that's nearly impossible to stop once it's spinning. Type 3, and this is the one most investors miss, switching costs. When the cost of leaving a product, whether that's money, time, or hassle, is too high, customers stay. Microsoft built an empire on this. Try getting a Fortune 500 company to migrate off Microsoft Office and onto something else. You can't. The training, the file formats, the integrations, it's practically impossible. Type 4, cost advantages. When a company can produce or deliver something cheaper than anyone else, and keep doing it for decades. Costco is a masterclass here. Their membership model, their bulk purchasing, their razor-thin margins on products. Competitors literally cannot undercut them profitably. And Costco's membership renewal rate sits near 90% year after year. Type 5, intangible assets. Patents. Regulatory licenses. Exclusive rights. Moody's is a great example. There are only 3 major credit rating agencies in the world, and the regulatory barriers to entry are enormous. You can't just decide to start rating bonds tomorrow. Now, knowing the types is step 1. But here's where most investors stop and lose money anyway. Theory is easy. Numbers don't lie. Here are the 3 metrics I look at every single time. First, return on invested capital, or ROIC. If a company consistently earns more than 15% on its invested capital for 10 years or more, something is protecting those profits. Competitors haven't been able to drive the returns down. That's a fingerprint of a moat. Second, gross margins. If margins are stable or expanding over a decade, the company has pricing power. If they're shrinking, competition is eating them alive. Third, the pricing power test. Can this company raise prices 5% tomorrow without losing customers? If yes, you've found something special. If the answer is no, keep looking. These 3 numbers tell you more than any pitch deck ever will. But even a great moat can disappear. And that's what the best investors watch for constantly. Kodak. Blockbuster. Sears. All three looked unbeatable at their peak. All three had what looked like classic Moats: brand, distribution, scale. And all three are now either bankrupt or a shadow of what they once were. Kodak filed for Chapter 11 bankruptcy in 2012. Blockbuster filed in 2010. Sears, slow-motion collapse. What killed them? Technology disruption. Changing consumer behavior. Management complacency. So when I evaluate a moat today, I don't just ask, does this company have a moat? I ask, is the moat getting wider or narrower? If Amazon is nibbling at your distribution edge, that's a shrinking moat. If your product is becoming a commodity, that's a shrinking moat. If a 10-year-old with a laptop could disrupt you, you probably never had a moat to begin with. The moat has to be durable. That word, durable, is everything. Here's the one principle I want you to remember. Price is what you pay. Value is what you get. But the moat is what protects that value over time. You can buy a great business at a fair price. You can even buy a fair business at a great price. But what you cannot do is buy a business with no moat and expect it to compound your money for 30 years. It will not happen. Find the moat. Measure the moat. Watch the moat. That's the game. What's one company you own, or are thinking about owning, that you believe has a real moat? Tell me in the comments, I read every one. And if this framework changed how you'll look at businesses from now on, hit subscribe. Tomorrow, we're looking at something even more uncomfortable, the one financial ratio that can tell you a company is in trouble long before the market figures it out. See you then.